Hello, everybody. It is time we are talking about a central bank. A central bank is a financial institution responsible for the formulation of monetary policy and the regulation of member banks. It typically has privileged control over the production and distribution of money and credit for a nation. Central banks are inherently non-market based or even anti-competitive institutions, although some are nationalized. Many central banks are not government entities and so are often treated as being politically independent. However, even if a central bank is not legally owned by the government, these privileges are established and protected by law. The critical feature of a central bank distinguishing it from other banks is its legal monopoly status, which gives it the privilege to issue notes and cash. Private commercial banks are only permitted to issue demand liabilities such as checking deposits. And then what a central bank does, especially in Indonesia, the Bank of Indonesia has several key functions. The first function, monetary policy. They use their policy interest rate to keep inflation low, stable, and predictable under a system known as inflation targeting. A flexible exchange rate also contributes to achieving their monetary policy objectives. And then the second, currency. They design, issue, and distribute Indonesia's bank notes. They make sure these beautiful notes reflect the country and that they are secure, functional, and accessible. And then third, financial system. They work to ensure the Indonesian financial system is safe, stable, and efficient. They provide central banking services such as settlement accounts and provide liquidity as needed to keep these systems and in turn the economy running smoothly. And how the central bank influences an economy. The first about macroeconomics influences, as it is responsible, for price stability. The central bank must regulate the level of inflation by controlling money supplies by means of monetary policy. Their actions directly influence market sentiment. The central bank performs open market transactions that either inject the market with liquidity or absorbs extra funds, directly affecting the level of inflation. To increase the amount of money in circulation and decrease the interest rate for borrowing, especially, the central bank can buy government bonds, bills, or other government-issued notes. This buying can, however, also lead to higher inflation when it needs to absorb money to reduce inflation. The controlling will sell government bonds and on the open market, which increases the interest rate and discourages borrowing. Open market operations are the key means by which a central bank controls inflation, money supply, and prices. And then the second, microeconomic influences. The establishment of central banks as lenders of last resort has pushed the need for their freedom from commercial banking. A commercial bank borrows funds to clients on a come, first served basis. If the commercial bank does not have enough liquidity to meet its clients' demands, commercial banks typically do not hold reserves equal to the needs of the entire market. So, the commercial bank can turn to the central bank to borrow additional funds. This provides the system with stability in an objective way. Central banks cannot favor any particular commercial bank. As such, many central banks will hold commercial bank reserves that are based on a ratio of each commercial bank's deposits. And then how do central banks manage inflation? Inflation occurs when prices continue to rise, meaning a country's currency is worth less than it was before because it cannot buy as much, also known as decline in purchasing power. Inflation is a sign that the economy is growing, often because demand outpaces supply and consumers are willing to spend more money on goods. But high inflation is a problem because it discourages investment and lending and wipes out people's savings as it erodes the value of money. For this reason, central banks work hard to keep inflation in check. Deflation is the opposite of inflation when there is a decline in prices. Too much deflation can drive higher rates of unemployment and can eventually cause consumers to default on debt obligations. For this reason, economists often consider a balanced economy to allow for some inflation but not too much. About 4 to 5% inflation is the ideal rate. And then, how do central bank policies affect interest rates? Most of the time, a central bank cannot set the interest rates on loans like mortgage, auto loans, and personal loans directly. However, central banks do have some ways to move interest rates to where they want to be. For instance, the central banks controls the policy rate, which is the rate at which financial institutions can borrow money from central banks. When banks can loan from a central bank at lower rates, they save money and give it to their clients and make loans cheaper. When interest rates are lower, people tend to borrow more, which means there is more money circulating. I think it's in this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.